Hey guys, this video is the first of a series of videos around picking stocks and what are the strategies, metrics and indicators you should look for when deciding to add a stock to your portfolio. And I'm gonna start with one of the key metrics that I use for valuing a company, the price to earnings ratio, or PE ratio if you prefer. The price-earnings ratio is the relation between a company's share price and earnings per share, and it shows basically what the market is willing to pay for a company's profits. The PE ratio helps investors measure the market value of a share compared to the company's earnings. In simple terms, you get to know how much the market is willing to pay for a stock based on the company's past and future earnings. For example, a high PE ratio tells you that a stock price is high compared to company earnings and may be overvalued. Similarly, a low PE ratio indicates that the share price is low compared to company earnings and is undervalued. However, you must determine if the reason for the share price being low is the company's underperformance over some time. Earnings are substantial when valuing a company's stock, as investors want to know how profitable a company is and how valuable it will be in the future. Moreover, if the growth and level of earnings of the company remain constant, then the PE can be interpreted as the number of years it will take for the company to pay back the amount paid for the share. Investors often look at this ratio as it gives good sense of value of the company and helps them analyze how much they should pay for a stock based on its current earnings. The formula and calculation used for this process are as follows. To determine the PE value, one must simply divide the current stock price by the earnings per share. The current stock price can be found simply by plugging a stock's ticker symbol into any finance website, and although this concrete value reflects what investors must currently pay for a stock, the EPS is a slightly more nebulous figure. And that's mainly because EPS comes in two main varieties. TTM is a Wall Street acronym for trailing 12 months. This number signals the company's performance over the past 12 months and is typically reported on a company's balance sheet, which is customarily updated on a quarterly basis. Now, the second type of EPS is found in a company's earnings release, which often provides EPS guidance. This is the company's best educated guess of what to expect to earn in the future. Both of these numbers can be found on the company's website. So yeah, you guessed correctly. Two types of EPS means we have two types of PE ratios, the trailing and forward PE respectively. Usually when analysts refer to the PE ratio, they are referring to the trailing PE. This measure is considered the more reliable of the two metrics since it's calculated based on actual performance rather than expected future performance. However, it could prove a limited or faulty estimate since a company's performance factors, costs and profits change over time. On the other hand, the forward PE ratio estimates a company's likely earnings per share for the next 12 months. This is favored by analysts who believe that investment decisions are better made based on estimates of a company's future rather than past performance. Now, because forward PE relies on estimated future earnings, it is subject to miscalculation or the bias of analysts. Also, companies might underestimate or misstate earnings to beat the consensus estimate PE in the next quarterly earnings report. So, having said that, please take into account both types in order to make your final decisions. In essence, the price to earnings ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earnings. This is why the PE is sometimes referred to as the price multiple, because it shows how much investors are willing to pay per dollar of earnings. If a company was currently trading at a PE multiple of 20x, the interpretation is that an investor is willing to pay $20 for $1 of current earnings. Okay, let's try to make things a bit more clear and see some examples. As a historical example, let's calculate the PE ratio for Walmart as of February 3, 2021, when the company's stock price closed at $114.27. The company's earnings per share for the fiscal year ending January 31, 2021 was $4.75 according to the Wall Street Journal. Therefore, Walmart's PE ratio is $114.27 divided by $4.75, which equals to 24.06. Easy. As an additional example, we can look at two financial companies to compare their PE ratios and see which is relatively over or undervalued. So, Bank of America closed out the year 2021 with the following stats. Stock price was $30.31, diluted EPS was $1.87, and PE was 16.21x. In other words, Bank of America traded at roughly 16x trailing earnings. However, the 16.21 PE multiple by itself isn't helpful unless you have something to compare it with, such as the stocks industry group, a benchmark index, or Bank of America's historical PE range. Now, Bank of America's PE at 16x was slightly higher than the S&P 500, which over time trades at about 15x trailing earnings. To compare Bank of America's PE to peers, we calculate the PE for JP Morgan Chase as of the end of 2020. So we have the stock price at $127.07, diluted EPS at $8.88, and the PE is 14.31x. Now, when you compare Bank of America's PE of 16x to JP Morgan's PE of roughly 14x, Bank of America stock does not appear as overvalued as it did when compared with the average PE of 15 for the S&P 500. Bank of America's higher PE ratio might mean investors expected higher earnings growth in the future compared to JP Morgan and the overall market. However, no single ratio can tell you all you need to know about a stock. Even though the PE ratio is a pretty useful and popular tool in the valuation of stocks, you cannot rely on it as a standalone criterion. It would help if you used it with other valuation techniques to arrive at the correct picture. The PE ratio is affected by the following parameters. First, the calculation of the PE ratio accounts only for the earnings and market price of an equity share. It doesn't look into the debt aspect of the company. There are companies that are highly leveraged and can be considered risky investments. However, a high PE ratio of such companies will not bring forth this aspect. Secondly, the PE ratio assumes that the earnings will remain constant shortly. However, earnings are dependent on a lot of other things and can be volatile. Next, an investor needs to invest in a company that keeps generating cash flows throughout its life cycle at an increasing rate. PE ratio doesn't indicate whether a company's cash flow is going to increase or decrease in the years to come. Hence, it leaves room for ambiguity as regards the direction of growth. Finally, it is assumed that a company having a lower PE ratio of 10 is cheaper than a company having a PE ratio of 12. However, you don't get any information about the quality of earnings of the company. If the company which is trading cheap has a low quality of earnings, then it can't be an ideal investment. Whether a PE ratio is considered to be high or low depends on many factors and should not be used alone to draw any conclusions. For instance, the IT and telecom sector companies have a higher PE ratio compared to companies from other industries like manufacturing or textile. So it is indispensable to examine the backdrop of the company considering all constituents before investing. Okay guys, I hope you enjoyed the video. If you found it useful, please consider hitting that like button and subscribing to the channel for more. I'll see you again next time. Bye bye.